In this video, we're going to be performing a deep dive on W. Grainger's dividend safety. To begin, let's talk about W. Grainger's business model. W. Grainger is one of the world's largest business-to-business distributors of maintenance, repair, and operations (MRO) supplies. The company was founded in 1927 and generates sales of approximately $10 billion per year. W. Grainger trades with a market capitalization of $16 billion and is headquartered in Lake Forest, Illinois. W. Grainger is a well-known dividend stock because of its compelling track record of dividend growth. With 46 years of consecutive dividend increases, W. Grainger is a member of the Dividend ARISTOCRATS Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors cannot rely on W. Grainger's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss W. Grainger's dividend safety in the context of the company's current earnings. When W. Grainger reported fourth quarter financial results on January 24th, the company announced that it generated adjusted earnings per share of $3.96 in a three-month reporting period. The company currently pays a quarterly dividend of $1.36 per share, which implies a payout ratio of 34% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. W. Grainger generated $16.70 of adjusted earnings per share in the 12-month reporting period and paid $5.06 of dividends during the same time period for a full-year dividend payout ratio of 30%. Using earnings, W. Grainger's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare W. Grainger's current dividend payment to its free cash flow. In the fourth quarter of fiscal 2018, W. Grainger generated $314 million of cash flow from operating activities and spent $70 million on capital expenditures for a free cash flow of $244 million. The company distributed $84 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 34%. Looking out over a longer time horizon, our conclusion is the same. In fiscal 2018, W. Grainger generated $1.1 billion of cash flow from operating activities and spent $239 million on capital expenditures for free cash flow of $818 million. The company distributed $316 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 39%. Using free cash flow, our conclusion is the same as when we used earnings to measure W. Grainger's dividend safety. The company's dividend appears extremely safe for the foreseeable future. Companies do not cut their dividends in good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze W. Grainger's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. W. Grainger's performance during this time period is shown here. W. Grainger's earnings per share declined by 14% peak to trough. In the depths of the financial crisis, before rebounding quickly in the subsequent fiscal year. Importantly, though, the company continued to cover its dividend payments with its earnings, and it continued its multi-decade streak of dividend increases. With that in mind, we do not have any concern about W. Grainger's ability to continue paying its dividend during future economic downturns. The last angle that we will use to assess W. Grainger's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. At the end of fiscal 2018, W. Grainger had $2.2 billion of debt outstanding and generated $588 million of interest expense in the 12-month reporting period for a weighted average interest rate of 4%. The following image shows how changes to W. Grainger's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, W. Grainger's weighted average interest rate would need to rise to above the 27% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that W. Grainger's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on W. Grainger's current dividend safety. We invite you to subscribe to this channel and to like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.